So here in this second video for Chapter 17, what we are going to shift our attention to is defined benefit plan. So just to recap quickly, in the previous videos, what we went through is kind of just a general understanding of what a pension plan actually is. And we discussed these two different categories of pension plans, a defined contribution pension and a defined benefit pension. And we ended that first video with looking at the very simple way on slide 6, the very simple way that we account for a defined contribution plan. So the very simple way is just to say every period when the company makes their contribution to the retirement fund, that company just records a debit to pension expense and a credit to cash for the amount that was contributed. That's it, right? So when we shift our focus to defined benefit plan through the rest of the lecture, the majority of the rest of the lecture, what we're focusing on is the type of plan where instead of the company promising to make periodic contributions to a fund, and then that fund is managed by the employee, by the individual. Now, in a defined benefit plan, what we're saying is that the company is essentially promising a fixed retirement benefit once that employee retires. So they're saying, okay, if you work for us for this long, then once you retire, every year we're going to still pay you a certain annual salary. It's probably not going to be in most cases the same amount that the individual earns while they're working, but they are promising a fixed annual salary to that employee once they retire. So more often than not, there's going to be a formula that takes into account the individual's years of service. It takes into account what their salary was when they, right before they retired. And in this particular example, you can see that the pension formula takes a certain pension percentage, as they call it, that would be used to apply to years of service and final year's salary. And this is one way, this calculation here of 1.5 times years of 1.5%, times years of service times final year salary. That's just kind of one way that they can do it. I mentioned in the previous video, the way that my husband's defined benefit plan works is that they take a certain percentage of his salary to say, okay, if you work for 30 years, we'll take 75% of your final year salary. Or if you work 35 years, we'll pay 80% of your final year salary. It is the same concept though, right? The longer you work, the longer your years of service, the more that retirement benefit is going to be. Throughout this lecture and through our examples and in the homework examples, this is the type of formula though that you're going to see. You're going to see this formula that takes a percentage times years of service times final year salary. So here in this very quick and dirty example, they said if the employee retires after 30 years of service and they had a final year salary of $100,000, if we take this formula, and again, this is a formula, by the way, that would be like outlined in an employee contract. They would state that this is the way that the defined benefit, the retirement benefit is actually going to be calculated. If that's the case, in this example, what we would calculate is that employee would be entitled to receive a $45,000 annual retirement salary once they retire, given this formula. So this type of formula that you see here is going to be what we use consistently going forward. A little bit more about defined pension plans, or defined benefit plans, you can see in that formula, there's a lot of uncertainties as it relates to how do we calculate what the actual benefit is going to be, and how do we, as accountants, get an understanding of what is the obligation, what is the liability that the company has to these individuals that they are promising this retirement benefit. What is that liability? There's going to be a lot of uncertainties and sort of estimations or guesses that we're going to have to make when we start to think about these things. And so some of the uncertainties listed on the slide is, how many employees are actually going to be eligible for retirement. A lot of times companies will say, you must work at least 10 years with our organization before you're eligible for retirement benefits. So the company then has to basically guess, of all of the individuals working for us, how many of them do we think are really going to stay with us for the 10 years so that they would become eligible. That's going to be an estimate that they have to make. For each individual employee, they would have to estimate, at what age do we think that person is going to retire? Because that's the point in time in the future that we would actually start to have to pay them these retirement benefits. We would start to have to, shell out the cash for that retirement benefit. So that's another estimation that we would have to make. At what age are these people actually going to retire? How long are they going to be retired? So it sounds a little bit morbid, but we would have to take into consideration what their life expectancy is. So if we think someone's going to retire when they're 60 years old, how long are they going to be in retirement? Because that obviously, for the organization, that has a significant impact on the overall liability that they have for this defined benefit plan, right? If you think someone is going to be in their retirement period for 10 years versus 25 years, that's a huge difference, and that's going to create a significant difference in the way that we account for that liability. Again, remember, in this chapter, what we're thinking about is what's the liability that the business has as it relates to these retirement benefits that they're essentially promising to these people. So these are the kinds of things that we have to think about and get an understanding of when we're trying to make that determination. So again, some of the uncertainties that are going to become apparent as we walk our way through the calculations that we're going to do related to these defined benefit plans. One other thing to understand about the way that these sort of estimations or these uncertainties are addressed. A lot of times organizations will either have an in-house or will hire an actuary. And an actuary is going to be someone who has a very specific set of skills as it relates to statistics and math. And they're going to be able to take into account a wide range of data in order to come up with best estimates for all of these uncertainties. So it would be an actuary's job to say, looking at something like the life expectancy of employees. The actuary would take a look at, okay, what's been the past life expectancy or the past retirement period for some of the employees within this firm over the last 20, 30, 40 years. They can do that for that particular company. They can do it for other companies within that industry. They can get these large data sets about life expectancy and come up with a best estimate for the individual employees to decide, okay, how long do we believe these people are actually going to be retired for? Because again, that's going to play into how we go about calculating the liability related to these defined benefit plans. So again, a lot of organizations will either hire or have an in-house actuary to help with creating these best estimates. The idea is you want to get as close as you can because this liability related to the defined benefit plan is going to be something that appears on the balance sheet. It's going to have an impact on the income statement, as you'll see when we go through some of these examples. So we need data and we need individuals who understand how to do statistical analysis to come up with those best estimates for us. Okay, so as we walk our way through these defined benefit plans, we're going to really look at three components elements, whatever you want to call it, that appear on the financial statements that are directly related to these defined benefit plans. One of which I've been saying already over and over again. There is a liability that an organization will have to include in their balance sheet, and that liability is directly related to the obligation, the promise that the employee has or has made to their employees related to these retirement benefits. Again, if you have a group of employees and you are promising to pay them all in retirement, to pay them all an annual salary, that's a liability. You're making that promise to them based on the fact that they are now working for you. So as they continue working for you, they are earning that retirement benefit. That's a promise that the organization is making to those individuals. Therefore, that promise needs to be represented as a liability on the balance sheet. So that's going to be honestly the first and most time consuming part of this, is looking at what that liability is going to be. How do we calculate it? How do we see it change given different scenarios over time? That's going to be, the employer's obligation, the liability that relates to these defined benefit plans is going to be where we spend a good portion of our time in these lectures. So that's going to be the first thing that we discuss. Then we'll move on to something called plan assets. Plan assets are very simply a set of funds that the company sets aside that they are basically earmarking those funds to say, this is the money that we are going to use to pay these retirement benefits. So over time, as more and more of their employees get to retirement age, the company would have to start setting aside more and more money in that plan asset funds, because again, they need to have enough funds available, enough cash really available in order to pay those retirement benefits that they're promising. So plan assets is very simply going to be a cash account, but it's an earmarked cash account. It's an account that the company is using to set aside for the sole purpose of paying out retirement benefits. Now, it's not going to be a cash account, again, that the company, takes cash out of their operating account and sticks it under a mattress. This is going to be an investment account. So over time, what a company wants to do, right, is they want to take cash out of their operating account and add it to that plan asset. But then over time, they want to earn a return, so that throughout the period that these individuals are working, the company doesn't have to keep flushing more of their operating cash into this plan asset fund, into this earmarked account. They can invest that cash and earn a return that will hopefully help the plan asset fund grow, so that there's enough cash available to pay those employees once they actually retire. So that's number two. And then the third element to this is going to be a periodic pension expense that we have. So again, as employees continue to work for us, as they, as time goes by, there is going to be periodic pension expense that we have to account for in our income statement, because just like a salaries expense, right? As the employees work for us, for our company, we incur that salaries expense. Same thing goes for these retirement benefits. As the employees are working, not only are they earning their salary, but they are earning this future retirement benefit. So because they are earning it, that means that we as the company are incurring it. So we're going to have a periodic expense related to sort of the ongoing time period that these employees are working for us. And we're going to see that there will be different components and in different different things that are included in the total periodic pension expense that we have in a given year, and we'll kind of break that down each individually, so that we can see how the total pension expense kind of comes together. But again, as I said, we are going to start this conversation thinking about the employer's obligation. So we're first going to look at what is the employer's obligation, what is the liability that they have related to this defined benefit plan.